Hello and welcome to a discussion on how the income statement and the balance sheet are related. After viewing this video, you'll be able to describe the accounts reported on the balance sheet when cash is received in a different period than revenue is earned. You will also describe accounts reported on the balance sheet when cash is paid in a different period than an expense is incurred, and describe accounts reported on the income statement when assets are used. The income statement follows the accrual basis of accounting. Items and amounts are not reported on the income statement because cash is paid or collected. Revenues are reported when earned, and expenses are reported when incurred. The income statement does not tell the user about cash. The income statement reports the earnings from activities that occurred during the period, and the balance sheet tells the user if cash has been paid or collected. Each income statement transaction has two parts. Two parts are required for the accounting equation to remain in balance. Let's talk about revenues first. Revenue is reported in the period goods or services are provided to the customer. Second, the question, was cash received in the same period, must be answered. If cash was received in the same period, cash simply increases. If cash was received in prior periods, an unearned or deferred revenue account was recorded when the cash was received, and the unearned revenue now becomes revenue. If cash will be received in the future, the balance sheet will report accounts receivable, which means customers owe the company. The accounts on the balance sheet that are related to the timing of when cash is collected for revenues are unearned revenue and accounts receivable. Unearned revenue is also called deferred revenue. Unearned revenue is used to show the amounts customers have paid to the company before the goods or services are provided to the customer. The company owes the customer, and a liability is reported. Accounts receivable is used when the customer will pay the company in a future period after the goods or services are provided. Accounts receivable is an asset because the company will receive future economic benefit when cash is collected. Cash received before the goods or services are provided is not reported on the income statement. Instead, the company reports a liability called unearned revenue on the balance sheet. Cash received in the same period the goods or services are provided to customers does not require an additional balance sheet account. Cash is increased, and revenues are reported when the goods or services are provided to customers. Amounts expected to be received from customers in a period after the goods or services are provided is reported on the balance sheet as accounts receivable. A revenue is reported on the income statement because the goods or services were provided in the current period. Each transaction that creates an expense also has two parts. Two parts are required for the accounting equation to remain in balance. Expenses are reported in the period that a service is provided to the company. The question of when cash is paid must be answered. If cash was paid in the same period, cash simply decreases. If cash was paid in prior periods, a prepaid expense was recorded when the cash was received, and the prepaid expense now becomes an expense. If cash will be paid in the future, the balance sheet will report accounts payable or other payable accounts, or accrued expenses or accrued liabilities. These accounts all mean the company owes a supplier or a service provider. The balance sheet tells the user when services are paid for. Prepaid expenses represent services that have been paid for ahead of time that have not yet been reported on the income statement. Accounts payable represents inventory and recurring expenses that have not yet been paid for. Other payable accounts mean that other services have not been paid for. If the amount is large enough, a specific account will be used to describe the service that has not yet been paid for. Accrued expenses or accrued liabilities also represent expenses not yet paid for. Accrued means not yet paid. An accrued expense account represents expenses that have been reported on the income statement and have not yet been paid. Services paid for before they incurred are not reported on the income statement. The asset cash decreases, and prepaid expenses is used to show that an expense has been paid for ahead of time. No expense is reported on the income statement until the company receives the service. Expenses incurred and paid for in the same period do not require an additional balance sheet account. Expenses are reported on the income statement in the period incurred regardless of when the service is paid for. A payable account or an accrued expense account is reported on the balance sheet to show that expenses have not yet been paid for. Expenses are also reported when an asset is used regardless of when the asset is paid for. The use of property, plant, and equipment is reported on the income statement as depreciation expense. The amount is the estimated cost of using the asset during the period. The cost of using intangible assets is reported on the income statement as amortization expense. The cost of using short-term assets is also reported as an expense on the income statement. Using inventory is reported as cost of goods sold. Using supplies is reported as supplies expense. Using prepaid expenses is reported as the name of the service that was paid for ahead of time. Providing goods to customers is a four-part transaction. First, the goods are provided to the customer and sales revenue is recognized. The customer either pays now or in the future, and cash or accounts receivable is reported. The second part of the transaction is that the asset inventory is provided to customers. Inventory is decreased, and cost of goods sold is the expense of using the inventory. Providing goods to customers requires four things to be reported. The income statement reports the sales less the cost of goods sold. The balance sheet records the decrease to inventory and an increase in cash or accounts receivable. After viewing this video, you should be able to describe accounts reported on the balance sheet when cash is received in a different period than revenue is earned. You should also be able to describe accounts reported on the balance sheet when cash is paid in a different period than an expense is incurred. And describe accounts reported on the income statement when assets are used. Please log on to StudyMyAccounting.com. The practices you learn will give you examples of each of the concepts discussed in this video. Work the practice test to verify your understanding and then check your answers to the answers and explanations provided. Thank you for being prepared for class. It is much appreciated.